Hey everyone. Today we're going to be talking about trading the memes, and that in today's case is going to be on ticker symbol AMC, which probably everyone here has heard of. They report their earnings this week on the 28th after market close, and there are some other intangible variables. So there's actually a second part to this video, which is going to be talking about non-earnings event related factors with any given stock that you're looking at, or just other exogenous risks. So we're going to be talking about that as well. But first, in the major portion here is going to be centered around AMC trading, meme earnings, and what to look for. What's important, what's not important, etc. That is what we're going to go over now. So let's begin. First, the scan. The scan is pretty much the exact same, so we're not really going to delve in too deep on it. But you guys probably know by now what you're going to want to look for is when you get paid, which is the implied move versus the average move here, giving us a 1.63 ratio. That is a great number. Then we also have, what is this implying relative to what it usually does, right? Because while we don't get paid for this, you don't want, there might be a red flag if it is, 50% above or 50% below. In this case, we're right at what it usually is. So we're right in this like premium spot, which is great. Now, quick look over the numbers. We got an implied move of 12.6%, an average realized move of around 7.7%, max move of 18.9%, and a straddle performance of negative 232%. That's indicated right here. So buying straddles on AMC, buying volatility around AMC has been abysmal, especially over the last few quarters or so, excluding this quarter that was reported in August where it blew up. But even then, right, this was only a 9% loss. So this really, in the grand scheme of things, has been surefire money in the bank, so to speak. And mostly it's probably due to retail traders hyping it up, right? Bidding up the calls, bidding up the overall spread of volatility centered around this thing. And just to see if that is happening again, because it's happened before in previous earnings cycles, we can see here that we have seen call skew go from, 0.79. So this actually puts skew on February 21st to now we're seeing call skew of negative 2.16 on the rating. That is indicating almost annually high call skew. Obviously good to see, right? Because if it's mostly retail, this is promising. This is what you want, right? Betting against traders that are simply buying something on the hopes of a short squeeze can be very good. Now, obviously, it can be very bad. All right. For example, looking at the relative value tab, right? It can be very bad because you guys probably remember what was going on back here. It's complete fiasco. Nevertheless, right? Before we look at the trade in itself and how to structure, how to capitalize on it, we need to look at, the risks in particular around AMC this quarter, the fundamentals. What we're seeing, guys, is EPS estimates, earnings per share, are pretty much the same as what they usually are, which is pretty much a good thing. In the grand scheme of things, it's very, it's easier sometimes for analysts to just see that. Now, what I will say is there could be some fundamental risks here from the standpoint that we've had Avatar come out, and we've had Puss in Boots and these other big movies that had huge box office numbers. This could lead to better promising numbers. So I think though that most likely could be a reason why we are actually seeing an uptick in this implied move, why there is, this ratio here this time around. It might be driven by that a little bit as well. So if that's driven mostly by retail, which it most likely is, it's never 100% to say, but considering we're talking about AMC, retail is probably the biggest player here. And something like that is probably very easy for them to make an investment decision on. So, next thing is retail. Now, we are actually seeing slightly bearish sentiment according to stock splits over the past couple of days, which is very interesting considering, we're talking about a meme that is beloved. Obviously, with 411,000 watchers, volume has ticked up on this, which is expected heading around earnings. So overall and above else, looking at the news, looking at things of that regard, really nothing crazy coming out of AMC. So before now we structure out the trade, I do want to make this point because this is extremely interesting stuff. If we go to the relative value tab, I just have AMC implied volatility for 30 days up from March of 2021 all the way to now. And what you're going to see is this was obviously, the mother of all short squeezes that happened in the summer of 2021. And you're going to notice over here that we're kind of seeing this clustering effect again over the past couple of weeks. I personally look in the news, it doesn't seem like there's anything really crazy going on. This was back, this whole area back here was mostly due to like, ape and things of that nature. This is mostly due from what I've seen, just short squeeze hype, right? Which is good. I mean, that is good, but that also carries risk, right? Because you run the risk that this could happen again. So the earnings event in itself may not be susceptible to that as much because obviously you're just in the position one day, you're out the position the next day. But for other trades, right, for other purposes, this could be extremely different. Now, like if you were trying to sell volatility, 30 days out, things of that nature, that might be a trade, and we might discuss that a little bit more in depth in another video. But as for now, just thought I'd make mental note of it to bring it to your guys' attention because there always is this risk that comes outside of the earnings event, right? There's always, like, for example, you can have a company that's set to release their financials one day, but let's say they have, like, an impending acquisition, right? So yes, the implied move is going to come down, but it's not going to come down, like implied volatility in itself isn't going to come down all that much because there's this, acquisition rumor, or there's a big case filing, or, there's rumors of the CEO stepping down, et cetera, et cetera, et cetera. So thought that was a really good thing to bring up, just so that way it's fresh in your guys' head when you're making trades. Now, lastly, is structuring out what this would look like. Again, it's pretty simple, guys. Most of these are going to be the straddle, right? It's the not one size fits all, but more times than not when you're taking trades where you're just selling volatility, shorter dated, it's most likely going to be straddles. As you can see here, if we fast forward to the 29th or March 1st, which would obviously indicate the end of the day, and we add in our forecast volatilities, which is going to be around. I mean, these numbers, by the way, are a little bit out of whack because it's after hours. We're going to see some pretty good prints if this average move is realized and volatility does collapse after the earnings event. You're probably wondering why, the average move, by the way, here on the price slice is so different. And that's because we're selling, in this case, the $6 options. Now, there's no 6.25, so you kind of have to pick one and let it stick. Or you can do something like a diagonal, which is essentially where you're going to sell like a $6.50 call, and then you're going to sell a $6 put. You can do something like that as well. It's kind of, I mean, it's basically like a strangle, but like it's a really, really, really tight strangle. I would say, you know, I would bet on whatever the stock has done in the past. You can make this like a delta bet if you wanted to. So, for example, if we go back to AMC on their earnings and we look at what this has done recently, we can see that, 3 out of the 5 last prints have been drawdowns. 4 of the last 6 have been drawdowns. Basically no move here, pancake. So really only 1 out of the last 6 times was, not going to the short side in terms of delta. Not probable, especially considering the sentiment, things like that. It seems like the retail investors are, completely, in this, bullish case, so to speak. Some of them, at least, not all of them, obviously indicated by stock splits. But there is this hype centered around, we had big box office, whatever, right? Like things of that nature could lead to, if they do have a print similar to what they had last quarter in terms of earnings per share, losing 20 cents, then we might see a bit of a sell. Again, that is just my own personal assumption. Um, you know, that is really where this comes into your own forte, so to speak. So break even is obviously $7.20 to the upside, $4.80 to the downside if you were to hold this all the way to expiration, which is going to be the end of the week. And yeah, guys, that is generally it. So, going over again the memes, looking at memes, looking at meme earnings is pretty much the same like everything else. It's just when you're looking at the fundamentals, you know already mostly that it's retail. So what you want to look at is you want to look at, what is retail thinking, right? As indicated here, what's retail thinking? What is the street thinking? Is there any discrepancy? Is there any difference? Is there any big news, big catalyst? And that takes me to the last point that we really talked about today, which is looking at, what could be going on outside of the earnings event, like this higher level of implied volatility that has been lingering over the past couple of weeks. So I hope you guys enjoyed this one. If you guys have any questions, feel free to message me. Also, if you guys want, comment your ticker, a ticker that you want us to take a look at in the comment section, and hopefully we have time to get it to you. And I will see you guys in the next one. Peace.